Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Amias Gerety, partner at QED Investors, a US-based investment firm focused on the fintech sector. Amias, if you can give us a brief insight into you, please.
All right, Alex, well, glad to be here. So my name is Amias Gerety. I'm a partner at QED Investors. I run our U.S. early stage team. I'm based in Washington, D.C., and QED is a large global fintech-focused venture firm. So we have almost $1 billion in our current fund. About 2/3 of that is focused on the early stage, call it seed to Series B, and then about 1/3 of that focused on the later stage, Series C plus. And we're one of a tiny group of venture investors who actually are this large, this global, and focused on fintech.
Perfect. Thank you very much. What mistakes do you see either venture capital or portfolio companies making, and what would you suggest to correct them?
All right. Well, so the what mistakes people are making is so market determined, and I would say right now, Alex, we're heading back into a market where there's a lot of FOMO and a lot of assumption that anything that has happened for 2 or 3 months in a row will happen indefinitely. So, look, it's tears and beers, right? For me to say, oh, I wish all my peers were more disciplined and didn't bid up the great companies that I like so that I could bid on them uniquely. But I do think that, in AI in particular, we've seen such fantastic growth. And it's totally makes sense for me as a venture investor to pay up for growth,
Mhm.
right? If you can see a company go from 0 to 50 million in a year, well, that's something you might want to be willing to pay for. But I think what we're seeing right now in the market is paying ahead of growth. Oh, because it's AI, it might grow. So let's pay as if it has already achieved this. And I think that's one big mistake that we see. It's a really hard market to stay disciplined in, especially because, those of us in venture, and I'm certainly no exception, we believe that AI is going to change everything.
Mhm.
So that for sure means that we should be excited. We should be aggressive. But boy, you can get on the wrong side of that pretty quick. And I'm old enough to, I graduated in college right after .com. I lived through the financial crisis at the Treasury Department. I went through the COVID boom and bust. So we've sort of seen this movie play out before. So that's a big thing that we're spending a lot of time thinking about and worrying about internally. Now, whether we're making mistakes by holding back sometimes or others are making mistakes by being too aggressive, only time will tell.
Absolutely. So, how do you stay disciplined then to keep you away from the shiny lights?
Well, one thing that we often do is we try to use some very simple heuristics on top of, what we call like hard thresholds. Like, hey, wait a minute. Has this company actually tripled in the last 6 months? Sometimes a company will come in, they'll say, hey, we've just hit an inflection point. We're we're about to explode. But actually, if you look at their trajectory, especially in venture in the early stages, you spend a lot of time wandering. And as call it a Series A investor, we like to say, well, wait a minute. Like, I know that your model says you're tripling, but have you tripled? Right? So sometimes we just like to take a big step back, or another way to do that is, oh my gosh, we're growing so fast. Okay, fine. But what is your CAC payback time? Right? You might be your customer acquisition cost and how quickly you can get that cost back in your business model. And, if it's not less than 6 months, you're actually pretty inefficient no matter how fast you're growing. Now, some companies, it can be 1 month CAC payback. Okay, great. Well, now we know we can put money to work. So a lot of what we do is just try to borrow heuristics from other market cycles and just always take a big step back whenever we're underwriting a company. Okay, of course you're excited about the team. Of course you're excited about the space. Of course you're excited about where they can go.
Mhm.
But let's just apply some very simple rules and make sure that we're not getting over our skis because of the incredible narrative that's coming along with the company.
So, obviously, more affiliated in private equity than I am personally in VC, but typically we're seeing a lot of this jumping over, as you put it, going ahead of your skis. interest in portfolio companies, especially with a slow deal market and deals are hard to come by. You're either sat on capital you can't shift or you can't get the capital in the first place. Is that similar to VC? Is this because of the huge competitive nature of deal cycles and trying to get the golden goose of propriety versus classic auction type model?
Yeah, I think that's right. So talking about, where people are on proprietary versus auctions, I mean, it is certainly true that in venture, basically no deal gets banked in the way that in private equity deals get banked. So the classic auction doesn't have quite the same framework, but there is definitely a sense in venture that you've got to be in, meaning understanding a company before they really start raising. And so I think in that sense, that's the right analogy for that proprietary versus auction. And, market dynamics change so fast, right? In 22 and 23, it was we would talk to companies that, oh yeah, yeah, call me when you're raising, right? Because we had confidence that the market wouldn't move so fast that if someone called us, when they were raising, we of course wanted to build a relationship ahead of time, but we thought time was on our side. In 2024, that started to shift a little bit, largely because of AI. In 25, that has shifted for buzzy companies, for hot companies, and this is very much a hot or not market, meaning the hot companies get super hot.
Yeah.
Companies that don't get hot just stay super cold. It's a very unusual market, even with sometimes the not hot companies have good metrics. So there's an interesting dynamic there that I think every venture investor is struggling to navigate. But the market dynamics change a lot. We are seeing right now that the only way to have proprietary deal flow is is to be so aggressive as to really understand which companies you want to invest in before those companies want to take your money. And again, unlike PE, venture companies, the best companies will raise money every 12 to 18 months. So you do have a relatively predictable cycle where you can say, okay, well, if someone I can tell who raised a seed round, I know they're probably going to raise an A, and so that creates my coverage universe. And what we try to do is make a distinction between what we call hunting versus gathering. And I think in venture, a lot of people talk about that networking, that aggressive talking about who's doing what, who have you heard that's hot. They think of that as hunting, right? They're out there hunting in the market. And what we've said to our team is that's not hunting, that's gathering. That's planting a lot of little seeds and hoping to get a little yield from each one, a little bit of conversation there. Hunting is when you say, I know there is one company I want to invest in the next 6 months, and I'm going to pull out all the stops to try and invest in that company. And I think that's sometimes a mindset shift between the, FOMO induced, who's hot this week? How can I chase that deal? And a slightly more aggressive form of, this is the one company that I think is going to be, the one that makes fintech in 2025, the one that's going to IPO in 2031, and I want to get in today. That's the kind of aggressive hunting mindset, which is a little different than what people often think of when they're just out there being aggressive networkers.
Makes sense. So your process then, how you mentioned you identify those businesses that you wanna invest in, and you then go out trying to build that relationship. How do you begin that connection? What's your kind of playbook to get connected with them and then build that relationship with them?
Yeah, so we do have a privileged position in fintech. We've been around for 17 years. We've had, a couple dozen unicorns. We've had many IPOs. So we are a big name. People will come to us.
Mhm.
But at the same time, in this competitive environment, I mean, when we started, no one was investing in fintech. Right now, all the big generalists have dedicated fintech partners, and they've done great fintech investments, and they really know fintech. Our companies and our partners have taught the whole market about what fintech is and what the possibility are, and we've certainly learned from others along the way. So I think the secret's out on fintech. So it's gotten a lot more complicated. But what we do is, it's a classic mix of art and science, Alex. So we do have a very disciplined coverage universe. We have about 150 venture funds that we respect. And so we're constantly tracking, okay, if one of these 150 funds does a deal, we should take a look. And then we're tracking that through. And look, that's a lot of companies. Now, on order of magnitude, there are about 150, 200 fintech deals a year in the early stage. So it's not an impossible universe to cover. And then we do a lot to keep ourselves accountable, right? So we have a watch list. So if I'm interested in a company, it goes onto the watch list. If I haven't talked to a company on my watch list, that's, you know, internally, I'm held accountable for that. We have Monday meetings and we go through the watch list, no connect list. Hey, Amias, you say you're interested in this company. What have you done to get in touch with them? We also have a watch list reconnect. Hey, Amias, you say you're interested in this company, but you haven't talked to them for 6 months. Are you actually interested? Because if you're not, someone else is chasing them. Or if you are, someone else is chasing them. And if you're not, take it off your list. It's okay to not be interested in a company. Um, and then, so that's kind of on the science part where we just try to be really disciplined. What is our coverage universe? Have we talked to everyone? Have we made a selection? And then the art part of it is we have to trust ourselves, right? If someone on my team has said, hey, I spent half an hour or I talked to another investor or I learned more about what their business, and I don't think that's a big company, great, move it to the side. We don't have to talk to everyone. We don't have to chase everyone. And then similarly on the art side, we like to just maybe about once a month, we just take a big step back and we say, hey, stop analyzing. Just in your gut, which of the companies that we're talking about, that other people are talking about, do you think are going to define fintech for the year 2025? Right? Just kind of let your gut speak. And so we do this mix, Alex, of science, which is try to be really disciplined, and art, which is, create space for the team to enunciate what is their gut thinking. And we think that balance helps us sort of listen to each other and say, hey, Alex, I actually think you love this company. Let's go chase that one. As opposed to, well, I don't know, like I looked at their metrics and the LTV to CAC isn't exactly where I want it to be, the lifetime value. If you really have passion, sometimes it is important to look to your gut. So that's how we like to mix the art and the science.
And then once you've identified these businesses, you mentioned the connection points. What are you doing there? Because I can guarantee they're just ringing them up and saying, "Hey, let us know when you're ready to do your next round. We'll be involved." And then next week, "Hey, we're still here. How's that round doing? 6 months. I'll be waiting. Call you next week."
Yeah, exactly. Exactly. Look, I think we like to say that deals are won and lost in the first call.
Okay.
So at QED, we actually have a pretty top heavy structure. We do not hire associates or analysts. We only have partners and principals.
Interesting.
And part of that is that our brand value is the best advice you can get in fintech. And
Okay.
so a lot of what we do is we try to be disarming and we try to demonstrate that founder friendliness, but not by saying we'll pay the biggest price or we'll be the easiest on governance, but saying, hey, let's just have a conversation in which you pretend I'm already your investor and I just try to give you advice. And if you like that advice, you should definitely be. And if you don't, then totally like leave us alone, judge us. So we try to be very top heavy, very kind of partners in first calls, principal, we're not trying to have sourcers call a CEO, spend a half an hour getting their metrics, putting a deal sheet together. We're actually trying to get on the phone with CEOs and create an authentic connection from moment one. I don't know whether it works or doesn't work. But I think our track record is pretty good, and that's how we think about it. The other thing that we like to do is to say, if we like a company, like I just did a company, I just, talked to a company at the Series A. They had a very small allocation. It was too small for us relative to where the company was. And I said, hey, we really like you. You clearly like us because you're asking us, if we want to come in on this round. So let's do this. Let's just set up a meeting after this round is closed. And let's do 45 minutes to talk about what your plan is from Series A to B. Just pretend we're already an investor, right? Let's talk about company building. Let's talk about if I were on your board, what's the advice I would be giving you? And that's kind of what we try to do in the connection. The other thing that we try to do, look, our founder, Nigel Morris, was a co-founder of Capital One, right? He's like lived a pretty awesome story. He's lived an awesome life. People like talking to Nigel. He's Welsh. He's got a great British accent. Like he's a very charming guy. And I think sometimes in our firm, we made the mistake of using Nigel in the last call instead of using Nigel as part of our outreach. Hey, like, you're building this company. We're not even considering investing in you right now, but I think it would be great for you to talk to Nigel. I think you'd learn a lot by talking to him. So that's some of the things that we've been working on over the years to make sure that we don't, hey, Nigel sits on high and, he's part of the final decision, of course. So of course, any CEO we invest in is going to talk to Nigel, but how do we put him earlier in the process? How do we use other assets that we have? My partner who knows, capital markets, my partner who knows consumer marketing, my partner who knows, the Indian market versus or the Nigerian market or whatever it is. And how do we bring all those resources to bear earlier in the process so that people feel that brand promise of the best advice you can get in fintech? Again, it's a very competitive market, so I wouldn't say this is 1 + 1 = 2, but it's something like 1 + 1 + 1 gives us a shot, and that's all you can ask for in venture these days.
Makes sense. What did you learn from the biggest mistake that you've made in venture so far?
I think so. Gosh, there's so many mistakes. Um, I think that one of the ways for me that I've made mistakes is I get enamored with the theory of the company relative to the the founders and the founders' capabilities, right? So the biggest mistake I've made was two founders who really didn't get along, and one of them was kind of the operating founder, and one of them was kind of the chairman. And I love the theory of the company, but the fact that they actually weren't on the same page, it just destroyed the company. I couldn't, and I was on the board and I was constantly navigating between them, and the company couldn't operate, and it made really bad decisions because of that. And I think that was one of these examples where I was like, oh well, like this could work. I remember we even had a separate conversation. We're right about to make the investment decision, and I was like, I don't like, this is really crazy. Like, I can tell that these two guys are not on the same page. But I think the theory of this company is so good we can overcome that. And in hiring, there's this line, if there's a doubt, there's no doubt, right? Meaning if there's a doubt, it's a no.
Yeah.
And I think that was an example where I let the theory and the uniqueness of the strategy blind me to the reality that even truly unique ideas um, will just falter if the team isn't aligned and if the team isn't geared towards the ultimate goal.
Yeah, we have a saying, it's in our top three hiring like mantras, and it's if it's a maybe, it's a no.
If
Um,
it's a maybe, it's a no. What a great line. Yeah.
we just
Yeah. And look, I think there's another thing, which is even more particularly, even more simply, in venture, if the CEO doesn't control the company, don't make the investment.
yeah, makes sense. I think
Now, that's obviously very different than PE, where obviously the whole point of PE is PE controls the company.
yeah, yeah.
But if there's an early money person or an early advisor or a person who owns IP or whatever it is, and the CEO doesn't control the company, in our experience, you just have to stay away. These early stage companies, they win because their founders win, and you have to back the founder. So there's a lot of great companies, a lot of great ideas that don't fit that structure. But that's one of the unique things about venture. It seems to be true, even though in a dozen other modalities, it works for CEOs to not control the company. In the early stage, if the CEO doesn't control the company, stay away.
Makes sense. I think with a private equity lens on that, it's all about, the good management team and a strong management team. And
That's
private
right.
equity do hire those management teams in, which obviously a little bit different from a venture cycle. You will eventually replace the founder at some point, usually.
Yep.
But certainly in that low middle market, first time private equity investment, if you invest in the wrong people, excuse me, if you invest in the wrong people, doesn't matter, a business is still likely to fail, even if it's fantastic. But it comes down to people, which obviously I would argue, given my role in
Exactly.
executive search.
And I will say for us, as fintech specialists, we love unit economics. We love data. We love analysis.
Hmm.
And it is certainly true that relative to some of our peers who just, the old phrase in venture is team and TAM. So total addressable market and the team. And, or you'll hear some great investors out in Silicon Valley say, oh, the way I could tell from the moment the CEO walked in the door that she was a winner. And, like, we at QED, we feel very uncomfortable with that, but, um, it is true that the greatest companies are built by the greatest CEOs, and so that's a tension that we struggle with in our business.
Interesting. So something I'm seeing from a professionalization of private equity at the moment is the operating partner, the value creation, the portfolio work, depending on what you call them, depending where you're listening in the world, portfolio value creation, SRG, all sorts of different things referred to, but we'll just refer to as operating partner for cleanness. So talk to us about the operating partner role from differentiation from venture capital to private equity.
Yeah, I think this is a place where, a thousand flowers are blooming in venture. Certainly there are some very big platforms like, Andreessen Horowitz has sort of elevated this to be huge, right? We've got 100 people or something like that, on the platform team. What we have found is that, you know, if you're talking about a small company, um, that company might have 10, 15, 20 employees. Even someone who can add a lot of value in theory is taking up so much time that unless their fit with the CEO is perfect, they can't actually add value, right? The CEO's time is so precious
Yeah.
that no matter how great the person is, they can't deliver relative value relative to the CEO's time unless there's a really great fit between the CEO and the operating partner. So at QED, we've done a bunch of experiments. We're pretty light on that model. Instead, we actually have a kind of a semi-affiliated recruiting and consulting firm, which is sort of where we stash or use kind of operating partner models. And I think that TBD whether it works. It's called Lingua Franca Partners. But that is a place for us to allow people to come in, be a little bit more independent, a little bit more entrepreneurial. So
Mhm.
we're not, they're not dedicated to our fund. They're individual professionals out, helping companies. And what we see in venture is the operating partner model works best when the goal of the operating partner is to land inside a portfolio company within 18 months.
Okay.
Now, in PE, I think you would say oftentimes that's similar, or maybe you have sort of two different models in PE. You have the sort of the retired CEO model, which is like, your like advisor or maybe board director, and then you've got your like real operating partner, and they're gonna drop in next time we have a deal that needs a go-to-market lead or something like that. I think in venture, because it's more fit-based and because these companies are so early, we find that the operating partners who succeed are very entrepreneurial and flexible, and they're really saying, "Hey, look, I want to help the portfolio, but really, I'm, you know, I'm going to do the try before you buy thing, right? The CEO is going to try my services. I'm going to try my cultural fit, and so I'm going to try and help three, four, five portfolio companies. I might try to help two or three portfolio, companies outside of the portfolio at the same time." And then over the course of a year or 18 months, my goal was to be the COO, the head of strategy, the head of sales, whatever it is,
Mhm.
inside of that company. And that's the model that we think works most, that kind of works best. I think one of the things that people can make a mistake on, and I often, you know, there are lots of exceptions to what I'm about to say, but if someone is becoming an operating partner with the hope of becoming an investor,
Yep.
that often creates real sort of clash because at the start of the relationship, the operating partner person, wants to pretend that they are open to lots of different things, and the venture firm wants to pretend that of course there's opportunity here because both people want the relationship to work.
Yep.
But then pretty quickly, 6 to 12 months in, if the operating partner really doesn't want to be an operator, they want to be an investor, investing partnerships are so small, they expand very slowly and very infrequently. And so it's quite rare for that switch to happen. And I think that's where I sometimes see this, where people get, you know, 6, 12 months in, they're pretty disappointed because they thought they were gonna, end up an investing partner. And the investing partnership is like, no, 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 I just wanted you to hang out for a little bit before I could stick you in a new company. And I think that's a tension that we sometimes see. So whenever think, especially for operating partners or people who are interested in that, that's the number one piece of advice I'm giving them is make sure that if you want to be an investor, you're hyper explicit about that. And therefore you only go to hang out with firms that are actually open to that,
Yep.
as opposed to saying, oh, I'm open to anything. And then you end up in a world that ends up with, it's kind of a be honest with yourself, be honest with the other. It's a classic hiring problem. But we think it's particularly acute when you have operating partner because it's such an ambiguous role that you need a real incentive alignment to make it work.
You referenced earlier your time in the Treasury and during the financial crisis. What did you learn working for the Treasury in that time?
I mean, so much, Alex. But I think it was a wild roller coaster, right? The I often say we talked about this at the start of COVID. Like, you know, crises happen because people become unsure of their fundamental assumptions, right? And, even at the start of COVID, it really felt like something that everyone was confident we were going to get through.
Hmm.
And so, I remember having a conversation internally at the start of COVID where I said, look, like, I think whenever we get through this, maybe it's 2 months from now, maybe it's 6 months from now, maybe it's 12 months from now, I don't think anybody's fundamental assumptions about how the economy works are going to change. So
Okay.
I think we're going to get through this pretty cleanly or quickly. Um, I think during the financial crisis, and whether this is true or not true, you had real doubts about whether, housing had any value at all. Now, again, I think looking back on it, you say, well, that was kind of wacky. Like people who bought housing did really well. Um, but, whether 150-year-old banks would fail next week, that's a very meaningful set of uncertainty about how our economy works, what is safe and what is not.
Mhm.
And so the number one thing, and I think there's a lot of talk now, whether it's crypto, whether it's stable coins, whether it's other forms of, AI or monetization in the financial services sector, people ask like, how does this, could this disrupt, could this cause a financial crisis? And one of the things that probably the number one thing that I learned about financial crises that I think people still miss is that financial crises are very, very different than recessions or other kinds of economic downturn. And financial crises happen when safe assets become unsafe. And that's going back to that assumption, right? When a safe asset becomes unsafe,
Mhm.
it undermines everything, and that's when you have a sudden stop. Whereas what happens in a recession is like, oh, well, I thought I was growing at 5% and now I'm growing at 0%, or I thought I was growing at 2% and now I'm shrinking by 2%. That's not a sudden stop. And so I think that's one of the big lessons that I learned. In terms of the applicability to venture, I think that for me, the number one thing is about making decisions given uncertainty, right? If you are if you're lucky enough to sit in a policy making seat when policy really needs to be made, you just you've two things that are true. One, you don't have time to figure out all the answers. And two, you cannot test your way in. Right? Like you can do a lot, you can try a lot of different things, you can be open-minded about, things working, not working. That was certainly something that we did in the financial crisis. We tried 18 different tools and only 3 of them really made a difference.
Mhm.
But what you cannot do is say, "Oh, I'm going to do a small test, and then if that works, I'm going to do more of it," which is how you do in business. And I think that's true for venture investing as well. The entire venture ecosystem, whether it's the time we take in diligence, whether it's the speed at which our CEOs need to move, it is about making very decisive and kind of almost irrevocable decisions on very little information. And I think that's one of the things that, people say, well, how could being a bureaucrat at the Treasury Department be like venture investing? But in that way, it's actually very similar, which is we didn't have an opportunity to get more information, and going small was not an option. Everything we had to do, it's like if you're writing the law, you're only going to get to do this once every 10 or 20 years. So you got to just write it down the best way you can. And sure, there were mistakes in that. But the fundamental decision making of here I stand, I've got the information I'm going to have, I've got to make a decision, or I've got to make a recommendation. Ultimately, Congress and the president ultimately make those decisions. But that's very similar to investing.
Interesting. What do you read, watch, listen to that you recommend that others should check out?
All right, so I read only old books. So like one of my favorite books is actually Frederick Douglass wrote 3 different autobiographies. They're amazing. The Origin of Species by Charles Darwin is an amazing book. Charles Darwin is actually a surprisingly good writer. Um, and then lastly, right now I'm actually Journey to the Center of the Earth, the old Jules Verne. It's it's a really funny book because we didn't we sort of he was so into the science and sort of like but exploring and creating sci-fi in an area that is now we just understand the center of the earth so well. So it's very kind of from the perspective of 125, 30 years later, it's kind of a silly book. He like goes down a volcano in Iceland and like then there's like a sea and dinosaurs underneath. Anyway, but anyway, so I really recommend. I love reading old books because they've sort of stood the test of time, and you can learn a lot because old books, people usually have 1 or 2 ideas from those old books.
Mhm.
And when you read them, they're always crazier and wackier than you would have thought. They're more different than you would have thought.
Interesting. And if anybody wishes to reach out to you post this podcast, how best they get in touch, please?
Yeah, LinkedIn is my primary social media, so ping me there.
Perfect. Well, thank you very much for coming on to the podcast, sharing your insights into venture, deal origination, the Treasury, which isn't something we discussed on the podcast prior. So, thank you very much for coming on,
Thanks, Alex.
and thank you very much, as always, to all of our listeners tuning in yet again to the Private Equity Podcast. Till the next time, keep smashing it.